In this week's video, we'll review the latest charts to help us answer the question, are stocks set up for a 10% correction before year end, or an ongoing rally with muted drawdowns? I believe that we've mentioned several times in recent weeks or recent months that the market is quite a bit different today than it was after the U.S. election, where there was a lot of conviction. We're still in a situation, summed up well by this Yahoo article here, where it's very hard to get a real theme because rotation between growth and value has been occurring pretty much over and over again under the surface. And in terms of the history of RSP, which is the equal weight S&P 500 index, we're really seeing something that's unprecedented. We have data going back to about 2003 for RSP. We've really never seen a situation, as noted by Bespoke Investment Group on the left side of your screen, where RSP underperformed SPY by such a large margin in a situation where the major indexes are printing new highs. And typically RSP doesn't underperform in a big way before the market rolls over. Typically they happen in unison, which in this case can be a good thing because it's telling us we shouldn't assume that this data here means the market is going to roll over, because if it was going to roll over historically, it should have already done so, helping us keep an open mind about a wide range of outcomes on all time frames. As noted, this is a data set that tells us we should be open to the market rolling over, but a study that was described in that same Yahoo Finance article tells us we should be open to the more muted pullback scenario. Once again, this study here was done by Bespoke Investment Group. It's discussed in this article. They went back and they tried to find years that were similar year to date, high correlations to the current market dating back to 1928. Quote in the lower left-hand corner of your screen. And only 2 of the 10 years most similar to 2021 as the second half featured a drawdown of more than 10%, with the median correction from highs only amounting to about a 2.3% drop. And the median gain the rest of the year, 7.1%, with 7 out of 10 of those historical cases gaining between mid-year and year-end. So data points that have happened in the rearview mirror since the beginning of the year tell us we should be open to that stocks could continue to rise with very, very muted pullbacks along the way. And if you watched last week's video, it's really nothing new. Similar concepts. This is basically stocks do really, really well in the first half of the year, which is the same topic we covered last week. And you might remember stocks did really, really well for the most part in the second half of the year in terms of average and median outcomes. And the drawdown, maximum drawdown in the second half of the year was relatively muted. Thus, probably fair to classify this as glass half empty. This is glass half full. Another data set, glass half full. Now let's shift gears back to a concerning data set. The chart on your screen shows S&P 500 stocks greater than their 200-day exponential moving average. Year 2000 on the left side of your screen, the present day on the right side of your screen. There's a reason why we've cut back on our small cap and mid cap exposure in the last several months. They've been very, very weak on a relative basis. You can pause your video player and read this text here, and I'll also tell you how to find this article. This study looks at Russell 2000, which is small cap, new highs relative to new lows, using data going back to June of the year 2000. As we know, the S&P 500 has looked good. The Russell, especially internals, not so good. In fact, something that just happened, weak new high, new low data, has only occurred 3 times dating back to June of 2000. That would be September of 2014, July of 2015, and October of 2018. In all 3 of those cases, 3 months later, both the S&P 500 and the Russell 2000, small caps, were at least 10% lower. Thus, a fair question might be, how does the S&P 500 look from a breadth perspective relative to September of 2014, July of 2015, and October of 2018, where eventually bad things happened? So let's take this data set on the top of your screen and zoom in to those periods. Same data set, 2013 left side of your screen, the present day on the right side of your screen. This is the first pullback here. Higher highs followed soon thereafter, but still, this is a sharp pullback here in 2014, and this is a significant pullback here in 2015, 2016, where my cursor's moving around in the S&P 500 index. And here's the third case here, fourth quarter of 2018, where my cursor is. So we can see here, this data set here is deteriorating in a significant way in this period here. Here, the market drops rapidly, and the data set deteriorates rapidly. Similar situation here, a very rapid deterioration. First thing to note, remember this study uses a data set going back to June of the year 2000. So let's look at the S&P 500 greater than their 200-day exponential moving average going back to the year 2000. You can see recent readings, we really don't have anything like the present day in that data set. Never get that high here, never get that high here. This is quite a bit different than the entire data set for this study here. And in fairness to the firm conducting the study, that's the data that they have. They can't control that. This is a sound study, a relevant study. If it wasn't, we wouldn't be covering it. It's also relevant, though, that the present day look of this chart here really doesn't look anything like this, and it really doesn't look anything like this. And really what we care about in the present day is the lead up to the problem. So what does it look like before this pullback? What does it look like coming into this pullback here where my cursor's moving around? And what does the data look like before this pullback, or even in the early stages of the pullback? And once again, if we examine that, the present day really doesn't look like those periods. Here's the first pullback here in the S&P 500, September of 2014. You can see, look at the data set here. It basically went sideways from high levels as the market was rallying. And if we look back 20 to 21 months here, it's really hard to make the argument that the market, which basically says investor psychology and also the weight of the evidence fundamentally, here looks anything like looking back 15 months in the present day. Similar situation here. Before this big drawdown in Q4 of 2018, where my cursor's moving around, coming into that, the data set really doesn't look anything like the present day. Looking back about 14 months, we move sideways, make a lower high, and then tank. If we look backwards 15 months, we're moving in this direction. This ends up moving in this direction, and this moves in this direction. As this case shows, things can change very, very quickly, and they may change very, very quickly. But they haven't changed yet as of the close on Thursday, July 15th. And our purpose here is not to discount this study. This is real data. It's data that we should respect. Really, what we're trying to understand is, what are the shorter-term odds that something like this has already started or is about to happen? And maybe more importantly, what should we look for in the early stages of something like that in these data sets to help us? Right now, this is not waving even really yellow flags at this point. Again, that can change very, very quickly, and it may change. Another relevant point. Here's where the S&P 500 corrects. Here's the movement, the range in the data set here. Here's where the S&P 500 corrects again, the movement before it here. Here's your correction here. Think of the amplitude of this range. So this is the amplitude of this range right here where my cursor is. This is the basic amplitude of this range here. Compare that to what we've seen looking back 15 months. This is case A, case A, case B, and case C, case C. Again, the present day looks very, very different from these cases here. That may change very, very soon in terms of weakness, but it hasn't changed yet. This just gives us another reference point of the same data set. Here's a pullback, here's a pullback, here's a pullback, here's some weakness. You can see where the indicator is during those periods relative to where it was as of the close on Thursday, July 15th. This is based on the exponential moving averages. If you don't particularly like that and you prefer the simple, very, very similar situation here, remember the blue and lines tell us when we drop below this level here and below these levels here, that's when things started to get a little bit more dicey in the 2010 correction scenario in the early stages and the 2004 correction scenario. Why are those similar? Because we had a huge rally off the low in the S&P 500 in 2002, 2003, and then a correction in 2004, and a huge rally off the low in 2009, and then the correction in 2010. So nothing particularly alarming here yet. Similar situation here. We noted this before. This is the correction here in 2004 where my cursor is. Here's the correction in the S&P 500 in 2010. Notice this indicator early in that process is here where the red line is and here where the red line is. As of Thursday's close, well above the red line. And really, really important to note here, we're not using these as forecasting tools. For the most part, these are coincident indicator tools, basically saying it doesn't look that bad yet. If we take on a look like this or a look like this, which could happen in the next few days, then we would learn something about increasing bearish probabilities. This is the look of the data set as of the close on Thursday, July 15th. Here's a data set that's a little bit more concerning. You can see basically the market rights itself in some of these cases near this general area. So this is telling us heading into next week, we really don't want this look here to morph into something like this, or to morph into something like this or this. This data set is for the broad, think more stocks, Nasdaq Composite Index. See how weak it is? There's a common theme here. We're basically in a situation here where large caps, so the narrower Nasdaq 100, a similar data set, looks a lot better. Look how far away we are from the blue and orange lines as of Thursday's close. As we always say here, stuff can change very, very quickly. And when this does change very, very quickly, what does that mean? That means market breadth is very, very lopsided over a very, very short period of time typically. Similar situation here, Nasdaq 100 greater than their 50-day simple moving average. Just not that bad yet. Here, weakness in the stock market, kind of a sideways weakness. Look where the indicator is in these areas here, and look where we are as of Thursday's close. Once again, we're not forecasting here. We're basically saying it just doesn't look that bad. If it gets worse, then we'll know the odds of something bad happening are increasing. Really, everything that we said about the last data set applies to this data set. This is where we are up here, just a little bit under 75 on Thursday, July 15th. If we get down into these boxes here, you can see in the relatively early stages of bad things happening, this tends to be quite a bit weaker than it is today. Now, we have been down here recently, and that is a yellow flag. If we come right back down into this area here, that would increase concerns. Broad S&P 500 as of Thursday's close, July 15th, really not that bad. Closed above both blue and both orange. Pause your video player here. When bad things start to happen, it makes sense that the number of new lows, 52-week lows, starts to expand. As of Thursday's close, muted at this point. Similar situation here. Here's the 2010 correction. You can see new lows, common stock only, expand significantly. Here's where bad things start to happen. We're just not there yet. Back to the common theme that larger capitalization stocks, Nasdaq 100 relative to the Nasdaq, tend to be in better shape. Here, last year, around the U.S. election, we had weakness in the S&P 500. See how the new lows start to spike up a little bit? This is where we are here as of Thursday. We just don't have it yet. Similar situation here. S&P 500 new highs minus new lows, July 15th, the close. We get down into this area here as we did before the COVID plunge. Doesn't mean the world is going to end. It just tells us that bearish probabilities are increasing. We're still above all of these levels as of Thursday's close. Covered these charts last week. Break of a trend, 2004. Break of a trend, 2010. During Friday's session, we don't have this plunge look here and this plunge look here yet. If anything, the bias has been to the upside. This is as of the close on July 15th. Similar situation here. What you're really looking for is a clear trend break. Don't have it yet. If anything, you can see as of Thursday's close on the 15th, we're about to print a new high here. Things can change very, very quickly, but as of the close on Thursday, they haven't changed yet. Think trend breaks here, clear trend breaks. This one's even intraday on Friday, July 16th. You can see it's just not that bad yet. Do we have some weakness? Yes, we do. The trend here is clearly up. That's quite a bit different than this plunge here and quite a bit different than this plunge here. And as you might imagine, when we're plunging in this area and the data set is plunging, market breadth tends to be very, very lopsided, noticeably lopsided. Even during Friday's session around lunchtime, just don't have it yet. In this data set, you're looking for a clear break of this trend from the March low in 2020 where my cursor is. We do have some weakness here. This is a failed breakout look, but we're still well above this trend line here. Not using this to predict. This is coincident. It just doesn't look that bad right now. How about the S&P 500? Clear break, weakness, clear break, weakness. Vulnerable here, but we don't have a clear break yet. July 15th close. Last week we showed the airline index relative to the S&P 500. It looked like a bounce here at this trend line during the session on Friday. Now it looks like we're below that trend line. Now trade the chart in front of you. In recent weeks and months, the shorter term trend has been down. You can make an argument. Shorter term trend is down, we hold. Shorter term trend is down, we hold. Shorter term trend is down. In this case, we're not holding. It's starting to look a little bit different. This chart may hold in this general area. This acted as support before, but it has to prove it. It really hasn't proven anything yet. Still common theme here in terms of leadership, especially leadership. This market really just doesn't have clear leadership. You can claim that tech is leading, but if it's the clear leader, tech is going to be making higher highs versus the S&P 500 and TLT. So when we're making new all-time highs in isolation, if you're really the clear, unequivocal leader of the market, you're going to be making new all-time highs versus bonds and versus the market. That may happen soon, but we just didn't have it as of July 9th. And remember, we said an indecisive market's an indecisive market. It really doesn't make a lot of sense to allocate with conviction when the market and the data screams indecisive. How does the same chart look this week? Fair to say weaker, but not weak enough to change the indecisive look. We held here, we're still here. You can see these gaps over here. Price action, the market was respecting this general area here. As of 1:16 p.m., we're still in that box here. And even at the close, still in the box. This is after the market closed on Friday, July 16th. We may not like it, but this box here still applies. FTech versus TLT a week ago. I said this was good here where we held. This week, a mixed bag. Last week, we did not have a break to a new all-time high. See, this is good. If tech is really going to lead, this is what you want. You want a breakout here. This is clear leadership if we can go on to print higher highs. We broke out. Now we still have the indecisive look. This is intraday on the 16th. Here's the close. The bad news is we didn't hold this breakout. The good news is we're still above this downward sloping trend line. Really not a whole lot of change relative to a week ago. And if tech is going to be the unequivocal, unquestioned leader of the market, it really needs to break out versus the equal weight S&P 500. See, this is clear leadership here, lagging here, trying to change here. What once acted as resistance, for the most part, is still acting as resistance. The difference is momentum down here is telling us that we should keep an open mind about a breakout occurring. This looks similar here. Here's the close on Friday. You can see price was rejected. It's a little bit different, though. Here, this is a significant rejection and reversal. Similar situation here. That's a pretty significant rejection and reversal intra-week. This is a weekly chart. Not as harsh here. And given this look here, and given this look here, and given that we're still above the 38.2% and hovering around the 50 and 61.8, hate to say it, but this is still indecisive. And what that tells us is there's nothing wrong with owning RSP and FTech. There's really no clear leader at this point. If this changes, then it helps you with weightings. This was the trend line that we discussed last week, S&P 500, July 9th, the low, tagged it here. Why do we draw it like that? Because this is the low, and we're capturing the highest high that was made. We draw it where we capture every single low. If we're going to roll over, we'll go into this area here eventually. The way we typically do this green trend line was manually drawn. You don't want to cheat with the trend line. You're not trying to say that the market's going to hold there. You're trying to learn something. If it holds, you learn something. If it doesn't hold, you learn something. So a good way to extend that trend line is just to draw a parallel line on top of it, which is what this dotted line is. And that way you know you're drawing the same trend line that you were referencing a week ago. And you can see near the close, still above that trend line. This is the close here. We're coming back and tagging it. So that would maybe be the good news. Let's say the bad news is you've touched that trend line or come very, very close to it several times in the past few weeks. You really need to make a stand relatively soon. Right now, this is unequivocally bullish. The last thing this chart did was make a new all-time high. For step 1, it needs to break below this trend line. And for step 2, we would need to see a lower high relative to these highs, and then we would need to see a clear series of lower lows. How could we possibly hold here from a fundamental perspective? Now, we all know that consumers are in very, very good shape at this point in terms of their personal balance sheets. How do we handle all of this? We trade the chart in front of us. Scenario A has to get the nod at the moment. That doesn't mean it will have the nod next week. Why? The last thing it did was make a higher high. If scenario B is going to unfold, we are not going to continue to have a chart that looks like this. Eventually, we're going to move into this area here, and eventually, instead of making a series of higher highs and higher lows, we're going to flip over and make a series of lower highs and lower lows. And that's true of the Nasdaq, and that's true of the Dow. So if this is going to happen, pretty much no, absolutely positively, we're not going to have a chart that looks like this. This chart is vulnerable, but it's still holding at this point. And if scenario B, a 10% correction, is going to unfold sometime between now and year end, let's say, we know data sets like this are going to show some significant deterioration. It's just the way it works. Just don't have that yet. Do we have it in some data sets? Absolutely, positively, yes. But the weight of the evidence in these data sets still tends to align with the chart that's making higher highs. This is a shorter term 20-day exponential moving average. And in terms of the large cap S&P 500, there's really nothing here at this point as of July 15th that's particularly alarming. And what are the odds that all of these charts deteriorated in a very, very, very significant manner on Friday? This is breadth data from Friday's session, 4:01 p.m. Eastern Time. It hasn't fully settled yet. This will give us a very, very close approximation of Friday's close. 67% in terms of declining issues relative to total issues. That's bad, but that's not a disaster. On the Nasdaq, it was 66%. Again, that's not particularly abnormal. That doesn't look like something that's going to cause a plunge like this in this type of data set. NYSE new highs 109, new lows 41. It's not that lopsided. This is a little concerning because it's expanding, and over here it's a little bit more concerning. You can see it flip back. This is 70 and this is 122. We did get an 80% down day, so I'd say that's a yellow flag. If you get another one on Monday, that would be another yellow/red flag, but you need some follow through on that. To discount that, only 68% of the volume was associated with declining issues on the Nasdaq. So something for the bulls and the bears here. This isn't great data, but it's not the type of data that has a dislocation look to it or a dislocation look to it. A dislocation look can happen very, very fast, as it did here, and it can happen very, very fast, as it did here. It doesn't appear that we're there yet. We'll see how it unfolds next week. This does have somewhat of a vulnerable look to it because we broke the trend line. We've talked about several things conceptually that we'd be looking for in terms of increasing probabilities relative to scenario B. Here are some other boxes that the bears would like to see checked. Recently, value stocks have been laggards really since this high here. This is value stocks here in isolation. Here's a look here. This is consolidation and the trend resumed. Right now, this is a weak look with consolidation. If we move into this area down here, and more importantly, stay there. Why am I saying that? Always have to be aware of the false bearish breakdown and a sharp reversal. Notice here, you had the false bearish breakdown, sharp reversal went on and made new highs. I haven't done that yet, but unequivocally, this looks weaker than this does. So if you're a bear, you want to get down here and stay down here. Similar situation. Small caps in isolation are not a disaster, but on a relative basis, they've been extremely weak. Bearish odds for the entire market would increase if this consolidation box breaks in this direction and the break stays in that direction. This is small caps SCHA, 3:46 p.m. before the close on July 16th. It did make a higher high here, so this is just indecisive. Nobody wants to hear that, but that's where we are. Similar situation here. Energy stocks have been weak lately. Some patience is in order. Price told us that this area here was relatively important. Around 330, we're in that basic area. And we also broke out to a new high here. Consolidation look, learn something if we move down here and stay down here. And we'll learn something if we hold in this basic area again. If you're looking for something that could get us leaning in the direction of scenario B and get us leaning in that direction very, very rapidly, something came out late this week that might help you out, and that's that the Fed is starting to talk more and more definitively about tapering their bond purchases. On Wednesday of this week, Powell basically gave the market a green light, said we're not close to tapering. Less than 24 hours later, we get a Fed speaker comes out and says, hey, we need to start talking about this seriously. If you read this article here, it's some of the strongest language that we've seen about tapering. The next Fed statement and press conference, they occur on July 28th. We handle all of this indecisiveness by trading the chart in front of us. Closed on Friday, July 16th at 43.27. This is a very, very short-term level at 43.20. We're still above it. This is not a take action type level for us. This is the type of level that if we hold it, you really don't have to get your contingency plans firmed up anymore. If you take it out, you take your contingency plans a step further. There's nothing wrong with being prepared. If the market continues to make higher highs, that's fine. You just take the contingency plans, wad them up in a little ball, and throw them in the trash can. The longer-term trends still favor tech and growth. Another reason to remain open to breakouts in this direction favoring tech and growth. Being open to it and assuming it's going to happen are two different things. It looks like it could happen, but it still hasn't happened yet. And we all know the best way to handle all of this is to trade the chart in front of us and head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.